We're going to go ahead and get started. My name is Mike Murphy. Welcome to the Micro E-mini Options launch webinar. I'm just going to turn it over to Dave, who's the head of education over at CME Group, and he's going to go through all the ins and outs of the new Micro E-mini Options.
All right, thank you very much. On behalf of myself and the CME Group, I want to thank Ironbeam for hosting us in this webinar. We have a lot of ground to cover. There's 47 slides here. Some of them are for reference, so you'll be able to look at later. I believe they're going to record this and archive it. So feel free to use a lot of this stuff as reference. There'll be some slides I'll skip over. There'll be some slides that I'll spend a lot of time on. So that's it. Real quickly though, the disclaimer, just remember exchange traded derivatives, futures and options, they're not suitable for all investors and they involve the risk of loss. So the one thing that we're going to implore people to do during these webinars is to do their homework, because as you know, options are four-dimensional instruments as opposed to the two-dimensional nature of futures. So you got to do a little more homework, and it's well worth it because of all the strategies available to you. So I've had the great privilege over my 31 years at the Merck to be associated with a lot of very good product launches and of course some not so very good product launches. But back in May of 2019, I did some of the launch webinars for the Micro E-mini futures, the Micro E-mini S&P, the Dow, the Russell, and the NASDAQ. And it's pretty interesting. We always have within our department, you know, we try to pick, we have a contest, who gets closest to the opening day volume. And the most optimistic projection was from someone predicting 100,000 contracts day one, which we thought was very, very radical. Interestingly, though, we traded 3 times that. We traded 310,000 on opening day, and we've done almost 400 million since then. So it's been absolutely incredible. There's a lot of reasons why. It's probably people in the audience such as yourself, firms like Ironbeam that supported us. A lot of active traders, retail traders that are coming on board with the micros. So, but the thing is, when we do all these launch webinars, the number one question I got in the Q&A session is, when will the options launch? So we're going to launch on August 31st. They'll actually start Sunday night, August 30th, but that's for trade date August 31. We're going to launch options on 2 of the Micro E-mini futures, the S&P 500 and the NASDAQ 100 futures. And of course, this is all subject to regulatory approval. I've never seen us have a problem with regulatory approval, but the legal people wanted me to put that in. So if you've ever wanted to trade options on futures, but you were hesitant, scared, whatever, the contract size was too big or the costs were too much, you now have another option. Excuse the pun. So my goal here is to make people ready for the launch and get you ready by giving you some of the contract specs, some of the basic, the nuances of various expirations, and of course get into some of our quick strike analytics that will help you become probably a better options trader. Maybe not a great options trader, but a better options trader, and it will help illuminate and elucidate some of the features of the Micro E-mini options versus the E-mini options versus the standard options, the standard, you know, contract sizes that we have. So as I said, we're going to launch 2 micro-sized options. One, the Micro E-mini S&P 500 options, and options on the Micro E-mini NASDAQ 100. We're going to, you know, we want to develop core liquidity in those 2 products first. They're the 2 most actively traded of the 4 major stock index futures. So if you want to ask a question later about when we're going to launch the, you know, options on the Micro Dow and options on the Micro Russell, go ahead. We like to develop core liquidity first in the S&P 500 and the NASDAQ, the micros. I'll have some charts up here. The next 2 charts show volume, and what they have to do with is if you ever expect to develop a core liquidity in your options, you're going to need some core activity and liquidity and critical mass in your underlying futures. I think maybe one time where maybe one time in my entire career there was not that much liquidity in the underlying, but the options had tremendous liquidity. It's very, very rare, but it can happen sometime. It wasn't on our exchange either. So we have a chart up here that shows average daily volume of the Micro E-mini futures by month, and you can go back all the way to May of 2019, and then you can see we traded between 400 and 500,000 basically for most of the first 8 or 9 months. Then February and March of 2020 came, and pretty interesting what happened when you have a pandemic and a global economic shutdown. in a 37% decline in the S&P 500 in basically less than 3 trading weeks, you get a lot of volatility, you get a lot of trade. You can see volume now is running between 1.5 and 2 million contracts a day for the most part. So very good critical mass in the underlying futures. It bodes well. It's not a guarantee, but it bodes well that the options will also attract a similar trader's attention. And also the next graph, it's entitled, "The Volume is Coming to CME Group. Micro options should contribute to this trend." And we really mean that. If you look at it, nice steady growth upward, volume, open interest, and all of our options products on the S&P 500 for average daily volume has been very, very good. The bulk of the activity, of course, is the E-mini options, so they do well. We look for the micros to contribute in a very substantial way to the growth of this chart, growth continuing. Okay, so why trade options? Probably about 10 reasons. There's probably 20 or 30 reasons, but we've distilled it down to 9 or 10. One, you get to do precision trading and scaling. All right, that means you can scale in and scale out. You got a contract that's 1/10 the size of the bigger brother, the E-mini S&P, so you can scale in the S&P 500 and the Nasdaq 100 exposure up or down. You can scale in, you can on the way up, you can scale out on the way up. You can do whatever you want. Instead of trading a 1 lot, you're likely to do 2, 3, 10 lots maybe because it's such a small notional value. You also add versatility to your trading strategies because you can use your long and short-term views because we have several different expirations. We have weeklies, we have end of months, and we have quarterlies, and that will help traders trade various different types of strategies. You also can avail yourself to all the option strategies that you do in any other futures contract or stock or ETF, multi-legged strategies, combinations, straddles, strangles, butterflies, condors, all those things. And you'll be able to take advantage of all these opportunities with micro E-minis. Anything you could do in the options market, anywhere else, you could pretty much do in the micro E-minis. You also have access to the micro E-mini futures liquidity. We just talked about that. We've traded over 300 million, probably closer to 400 million contracts since launch. It's the most successful product launch in the history of the Merc, probably of any exchange in the world, but I haven't verified that yet. And the premiums will settle into these liquid futures contracts. Any exercise assignment will result in a futures position and in a very liquid contract. We have the CME Clearinghouse, very important. Most people don't know too much about the clearinghouse, but they are the crown jewel of the CME, so to speak. They're the ones that make it very credible to trade at an exchange. They're the ones that debit and credit accounts accordingly every day. So if you make $1,000 and I were to lose $1,000, they would debit my account and credit your account. They change margins, they set margins, they do variation margins, they make sure the integrity of the system is intact, and it protects the FCMs, the brokers, and it protects the client, and it protects the exchange too. There's tax efficiency. This is mostly for U.S. participants only, but you're taxed on futures and futures options at the 60/40 rule. It's Internal Revenue Code, Section 1256. 60% of your gain is, 60% of your gain is long-term capital gains, 40% is ordinary income. Be careful, make sure you talk with your tax advisor before you do anything regarding this if you want to know. But the tax savings, it can be significant. If you're a good trader and you're making money consistently each and every year, this tax savings will add up, all right? If you trade a stock or an ETF and you have a short-term gain, you don't get the 60/40 rule. Everything is taxed at everything is taxed at ordinary income. I get the two mixed up all the time. My apologies. You have offsets, the micro and E-mini offset, and also margin offset. So if you traded into one E-mini option and you wanted to offset it by, trading 10 micros, you could do that, and vice versa. If you have 10 micros and you want to offset it with one E-mini, you can do that. You just have to notify your broker. They will deal with the clearinghouse, and they will offset, and the position will net out to zero. There's also, if you do combinations, futures and options, there will be certain margin offsets for traders too. All right, not too many people doing futures and options combinations, but there are some. Liquidity. We all know how liquid the S&P complex is. Actually, it's about 9 times they trade. They trade about 9 times the value of the S&P 500 ETFs. They trade 60% more than the value of the underlying S&P 500 cash basket. Same thing with NASDAQ. They trade about 8 times more the value of the QQQs and 20% more than the entire value of the underlying cash NASDAQ 100 basket. You also have around-the-clock trading, but most people know that. You can trade almost 24 hours. We don't trade on Saturday. We don't trade on Sunday till 5 o'clock Chicago time. But if you want to make a trade at 2, 3, 4 in the morning, many of our contracts are very, very liquid in the middle of the night. So if something happens in Asia or something happens in Europe and you want to initiate or offset a trade, you can do so. Also, the futures market strength, what does that mean? Technical levels are usually determined in the futures, not the underlying. Now, what did I mean by this? Well, very simple. There's a lot of money that flows into the derivatives. As we said, the S&P 500 futures complex trades 9 times the value of all the S&P 500 ETFs. So believe it or not, when you run your Bollinger Bands, your RSIs, or any kind of indicator, it usually runs off the futures because there's so much money and so much critical mass in the futures, all right? Of course, we also have a very diverse client base. This helps grow volume in our products when we launch them for the most part. But the most important statistic on this page is the more than 75,000 accounts that have become first-time traders at CME. That's amazing. And we got there in less than a year in a new product. And to bring on 75,000 new traders is absolutely incredible. So it explains why we're doing, 1.5 million, 2 million contracts a day. Everybody wants in on this contract. So we have active traders, we have hedge funds, we have proprietary traders, we have market makers, of course, and smaller institutions sometimes will trade a smaller contract for smaller accounts. All right, so comparing stocks versus options on futures, options on stocks versus options on futures. I know that we're going to have a lot of people that are new to options. We're also going to have people that trade stock options or ETF options. You should understand some attributes of the various, in comparing. You should be able to know some of the comparisons between the two products. So when you do options on stocks, generally the underlying is 100 shares of stock. So, 100 shares of stock. So if you exercise an option, let's say you're long a call option and it goes deep in the money and you exercise, you will receive 100 shares of Apple or 100 shares of General Motors or 100 shares of, Salesforce.com. With options on futures, you exercise, you get a futures contract. This is the key difference, obviously. Your underlying changes from a stock, 100 shares, to one futures contract. The tick values with futures and options on futures, the tick values, the minimum price fluctuation varies by product, all right? With options on stocks, it's generally a penny. So you have a penny versus, it could be a quarter, it could be a dime. It depends on the option. It depends on the futures contract, okay? So no problem with that. That's pretty straightforward. Now, expiration considerations. When you do exercise and you get a futures contract, you have to remember futures have discrete expiration. So if you exercise, you had a long call, a September long call, you exercise, you would get a long E-mini S&P or a micro E-mini S&P futures contract. And that expires the third Friday in September. So you go into futures contracts, they expire. When you go into, when you exercise a stock like Apple or General Motors, for example, stocks can be held indefinitely. They don't have expiration. So the tick value and the expiration consideration are two very important things. Around the clock trading, obviously we talked about that, yes, with futures and options on futures, not really with options on stocks. Unless you're extremely well-wired institution or something like that, giant hedge fund, trading overnight it's tough. And not only that, if you can trade, liquidity is just not that good on options on stocks. We have pretty good options liquidity and futures liquidity overnight here at the CME Group. Asset classes with futures, you get equities. You can have, there's currency futures and options, interest rate futures and options, and commodity futures and options. So if you want to trade crude oil, natural gas, heating oil, gold, silver, platinum, palladium, you can do that. And there's options on all those products too. Almost every one of our products has an option component to it. Almost, not all of them. Options on stocks, the asset classes, well, it's equity. And nothing wrong with equity. Just you want more asset classes available to you, the futures market can offer more. Liquidity, both of them vary. There are some options on futures that are amongst the most liquid instruments in the world. Options on Eurodollar futures. There is nothing more liquid on this planet in terms of options. You can do a $10 billion notional trade, no problem. There's guys down on the floor that'll make a market, and they're not even big institutions or individual traders. That's how liquid it is. And then, of course, there's some options on futures that are a little less liquid. The same thing with options on stocks. Not everything is as liquid as Apple or the SPX or something like that, or the options on the SPY. But tax efficiencies, as we talked about, options on futures, yes. Options on stocks, no tax efficiencies on short-term gains. Margin and capital efficiencies, when you do futures, the underlying futures, 3 to 10% of the notional value. You'll put up a much, much smaller amount of money. With options, you'll put up the actual premium, and that's it. That's your maximum risk when you go long options. With options on stocks, you borrow 50%, you put down 50%. Okay. And then volatility issues. In the stock market, volatility skew. It's the tendency of out of the money puts to price at higher volatilities than out of the money calls. And in the stock market, the out of the money puts trade at higher volatilities. The reason why is human behavior. When we crack the market, usually when we see big exaggerated moves in the stock market, they're down. We've had more crashes, so to speak, or severe or substantial downward moves in the stock market than upward moves. So if you look at the biggest days of trading, it's usually when the trading's on the downside. So as a result, we have skew, and traders know this, and puts will price higher than calls when they're out of the money. With certain products, though, like interest rates or currencies, the volatility skew is different. Out of the money calls and out of the money puts tend to trade at similar implied volatilities. But with options on stocks, skew tends to price puts greater than calls, just like stock index futures options. So be aware of that. All right, so here's the contract specs. We won't go over every detail on here, but this is the contract specs for the Micro E-mini S&P options and the Micro E-mini NASDAQ 100 options. The contract unit, as we said, it's an underlying futures contract. One MES futures. MES is the Micro E-mini S&P. MNQ is the Micro E-mini NASDAQ. The minimum price fluctuation. Remember, stocks and stock options are pennies. Well, with these two micros, the minimum price increment is 1/4 of an index point, and that equals $1.25 for the micro S&P, and that equals 50 cents for the Micro E-mini NASDAQ. And that's for options premiums that trade above 5 index points. If it's below 5 index points, you have a reduced tick size. So when we get really small options, you'll be able to trade in smaller increments. The trading hours, basically, they start up at 5 o'clock in the afternoon on Sunday, or 5 o'clock in the evening, and they go till 4 o'clock in the afternoon on Friday. This is Spaces Chicago time. The product code, we'll go over this real quickly. I'm going to show you an expiration calendar that'll make things much, much easier. But there'll be a quarterly option. The code will be MES, just like the futures. End of month will be EX. And the weekly options, there'll be 4 weeklies that expire on consecutive Fridays, EX1, EX2, so on and so forth. And with NASDAQ, it'll be MNQ, MQE, and then MQ1, MQ2, MQ3. Don't even pay too much attention to that at this point. We're going to have a calendar coming up in the next slide or the slide after that will make this much clearer. The listing cycle, so we'll have 2 quarterlies, 3 end of month, 5 Friday options, including the serial, and weeks 1, 2, and 4, plus 2 serials. So that gives you 5 Friday options. Again, you'll see it on the calendar. It'll be better. Much easier to understand. Option style, the quarterlies are American. Therefore, you can exercise anytime between purchase and final settlement. And all the end of month and weeklies are European. You can only exercise on the final day of trading. Real quick, liquidity provider and market maker program. Again, pending regulatory approval, we hope to have an incentivize certain market makers. I believe we have almost a dozen at this point, which bodes very, very well. And they will hopefully make markets in all 3 time zones and do a really good job. One of the, there's a lot of reasons why the micro futures were very successful. One, it filled the need. It was a great product. The E-mini S&P 500, the standard S&P 500, the standard contracts, the E-minis, because of the bull market generally went up and up and up, and the notional values got very, very large. Excuse me. Been doing a lot of seminars. My throat's a little scratchy. So one of the reasons why is it fills a need. Second, we're going to pat ourselves on the back. We did a great job marketing and coming up with contract specs and all that, and research and dealing with our client base. But the third reason is folks like you that log on to these webinars. We want to thank everyone for your business, for helping make the futures a success. Hopefully the same will occur with the options. But one of the big reasons why too is because market makers. We had very good market makers. We had like 20 of them for the futures in all time zones. So there's deep liquid markets and very good depth of order book. So you can trade. All right, we're going to skip this chart here. And here you go. Here's the calendar. And this is what it will look like when we first launch the product. All right, this will be the first, when we first launch in August 31st, this is what the calendar will look like. These are the expirations that will be available. So you can see in blue, we have weeks 1, 2, and 4. You can see September 4th, September 11th, and September 25th. Those are the weeklies. Then you'll have an end of month, and then September 18th in green, that's the quarterly expiration. Remember, stock index futures, all of them go off, or not all of them, but the major ones in the S&P and the NASDAQ and the Russell have March, June, September, and December expiration. So there you see September 18th, and there you see December 18th. So the third Friday of the contract month, September and December, those are quarterlies. They go off the board quarterly. All right, then you have the weekly options, September 4, 11, and 25. And then you see October and November, the third Friday. Well, there's no October futures. There's no November futures. So we call those serial months. Some people call them week threes. Some of them will call them serial months, option expiration. You'll see both of them. So that's why I'm telling you about both of them. I don't want you to be confused. So it makes it much, much easier. And again, this is what it will look like when we launch on August 31st. And also when each time, like September 4th, when that comes about, when that weekly option expires, they'll roll another expiration under there for the first Friday in October, so on and so forth. So eventually those will all expire in September, those weeklies, and they'll list new ones on the Friday. All right, so you'll have quarterlies, you'll have end of month, and you'll have weeklies, and the week threes and the serials are basically the same thing. All right, and there's a good diversity here. You have lots of different expirations. So if you wanted to, gauge or trade based on earnings announcements or CPI announcements, you don't have to do a quarterly option. We have an example, an illustration later on that we'll talk about that. All right, here's a little coded color chart. Everything in green is an American style expiration. All quarterly options are American style expiration. In other words, you can exercise anytime you want between purchase and the final day of trading. However, we have these other options. We have the end of month options, and all these products have end of month options. All these products have Friday weekly options. Only the E-mini S&P options have a Monday weekly and a Wednesday weekly, so you can trade intra-week expirations, if you will. But the micro E-mini options, the regular E-mini NASDAQ options, the micro E-mini NASDAQ do not have Monday and Wednesday weekly expiration. They only have Friday weekly expiration. So you'll have Friday weekly, end of month, and quarterly. And remember, the Friday weekly and the end of month are European style expiration. You can only exercise at the final day of settlement or final day of trading. Okay, so let's look at a strategy or a couple of them and see how the market prices things. So you can compare the standard S&P, the really big monster, $850,000 notional value contract. Doesn't trade as much as it used to, but it's still around. The E-mini S&P 500 and the micro E-mini. Now, remember, the micro E-mini hasn't started trading yet, so I had to do theoretical products. I had to go to our Quick Strike software, which we'll talk more about later, and put in various things and get some theoretical numbers. All right, so this is a vertical spread. We're comparing the cost of a vertical spread, the 3270, 3370 vertical spread. It's a vertical call spread. It's a bull spread with calls because you're buying the lower strike and selling the higher strike. So in the standard S&P, it's 6410 for the call, 3270, 2180 for the 3370 call. You're buying one, you're selling the other. The cost of the vertical spread is 4230. The contract multiplier is $250. All right, look over at the E-mini now. it's 64. There's a little bit difference in the tick. Now, notice, or one thing you need to be aware of is the micro E-mini and the E-mini may trade at different values, very slightly different values. Over time, as liquidity grows, you should see them be very close in price. But there's another reason why they may be different than the standard S&P, the tick size. The standard S&P moves in 0.10 increments, it moves in dimes. The E-mini and the micros move in quarter increments. So that alone guarantees that you will not have identical, most of the time you will not have identical premiums. But you can see they're very close. So the cost of the vertical is $42.30 for the standard S&P, $42.25 for the E-mini, and $42.25 for the micro E-mini S&P. The contract multipliers are $2.50, $50, and $5. So look down on the green line now. The cost of the vertical spread, $10,575 for the standard or the big S&P 500, $2,112 for the E-mini options, and only $211. This is just because the multiplier is only $5. It's 1/10 the value of the E-mini, and the E-mini is 1/5 the value of the standard S&P. So this shows a substantial difference, big difference for those with smaller accounts or beginners or people that are novices. You can trade this vertical spread for $211 with the micro when we launch it. Again, these are theoretical prices. We're not trading the micros for another 5 or 6 trading days or a week. August 31st. That's next Monday. So does that make sense? And remember, there can be no guarantee that the E-minis and the micro E-mini options will trade at identical prices for a given strike and expiration. I want to make that perfectly clear. If they get too far out of line, if the vertical spread was 42.25 in the E-mini, and in the micro it was 62, someone's going to arbitrage that or spread it, all right? But I don't think it's going to happen. Just a guess. Comparing the cost of straddles, we won't go through everything again, but this is the 3260 straddle. You're buying a call and you're buying a put. Look at the cost of the straddle. Look at the green line in the middle that goes across, $37,000 versus $7,500 for the E-mini S&P versus $753 for the micro E-mini. Incredible difference there. Again, those with less well-capitalized accounts, those that are a little bit intrepid about trading options on futures, this fills a need. All right, I'm going to keep saying that. This fills a need. All right, so I'm going to talk now about the weekly options and the difference between weeklies and quarterlies, and some of the reasons why they become so successful and why you need to pay attention with these with the micro E-minis as well. They're perfect. I'm going to start on the right-hand side of the page. They're perfect for event-driven trading. You get deep pool of liquidity in the underlying. You have unemployment report days. You have trading in the nearest 2 weekly options that exceeds average daily volume by 100% sometimes. So on unemployment days, big numbers, you can double our volume in these things. That's pretty incredible. We have earnings announcements in the NASDAQ 100 and the S&P 500, and it's incredible. So the key features, it's European style. The weekly options are all European style. There's no pin risk, no contrary assignment or abandonment. We could study that later. You can ask me questions later if you want to know what that means. But European style, most of you understand, you can exercise only at final settlement or on the last day of trading. Weekly options, they can be used to hedge any long-term position. Even though they're short-term options, you can use them to hedge long-term positions. They also have very high gamma. For those that are uninitiated, we're going to go over this a little bit later, but you have high gamma because when you get close to expiration, the deltas change very fast, and the rate of change of delta is measured by gamma. Theta is the time decay that comes off an options premium every day. So it's time decay, theta and time decay. You have high theta, so there's a trade-off. You have very high gamma, but you also have very high theta. So you're giving up, you're getting time decay to get gamma. And people that want to do event-driven trading, this is exactly what they want. They want large gammas, large changes. And you can initiate new positions to anticipate something happening in the next 1, 2, 3, all the way up to 7 days. So let's look at this now in a beautiful graphic, or a good graphic, nice graphic. You can see there, this is comparing all the premiums. This is using micro E-mini NASDAQ 100 illustration. We have August week 1, already expired. August week 2, already expired. August week 3, already expired. And August week 4 will go off the board very soon. This is the 11,090 strike price in the NASDAQ 100. And you can see the premiums for week one. Doesn't matter that it's expired. When I made this chart, I just was showing you the difference. The premium is 92.25 points. This is incredible. Look at the difference, though, between the September 2020 and the August week one. 92.25 versus 402. That's a big difference. Look at the premium in dollars. $1,845 versus $8,000 if you did it in the E-mini NASDAQ, the NQs. If you did it when we start trading the micro E-minis, it's $184 versus $804. So we've given you a really good graphic representation of how the premiums are going to look with the last two charts, last two pages, and also how the short-term options are going to work, the weekly options. So much, much cheaper. In the old days, we had to trade quarterlies. That was it. You were stuck. You had to pay the $8,000. Now you have end of month. You have various weeklies, so it gives you a lot of versatility to set up strategies. All right. We got a couple slides here about quarterly options being American style and end of month options being European style. This is some of the reference I wanted to provide for people. You can look at these later in the archive version, or when you get the PowerPoints, you can do that. Ironbeam has full permission to send out the PowerPoints to anyone that asks. Just use them only for yourself if possible, okay? But you can also, they'll archive this and you can look at it again and you can see some of the expiration nuances between weeklies, end of month, and the quarterlies. And again, there's another chart that gets into a little bit of details about when you can exercise, how you exercise, how do they determine whether something is in the money or out of the money on a serial option or a weekly option. And there's a price fixing that they do in the last 30 minutes of trading before a weekly option or before an end of month option. So I advise everyone on to click on the FAQ down there. There's an FAQ for options and it goes into more detail if you want to know these things. Most people don't hold these things in expiration, so most people don't care so much about these details and these nuances. But you might want to know if you want to hold something or you're short an option and you want to know about how assignment can occur and how late it can occur. All right, so let's talk about some other things that you can do with these. Precision scaling, and we'll have a little chart up here that will show it as well. So as with micro futures, a smaller size allows traders to more precisely scale in or scale out. All traders have been in the position where they buy one lot and watch the market rocket higher after they offset the contract. So we've all been in the position we bought a one lot, market went higher, we sold it, and we made a profit, but the market went higher still. One of the nice things about with the micro E-mini options, the smaller size allows you to trade a 10 lot or a 3 lot or a 5 lot, and that you can scale and get out a little bit at a time or get in a little bit at a time. So 10 MES options would be the equivalent of 1 ES, 1 E-mini option, all right? If the market goes in your favor, you can scale out of a few contracts and still be in the market as it continues. It's a technique that's often employed by professionals or active traders that do a lot of trading. It's a very popular type strategy. So let's take a trader. This is actually an illustration. He buys 10 3,200 strike MES call options. That's options on the micro E-mini S&P. And he buys them with the underlying at 3190. He's got a trading system based on relative strength index. For those that are uninitiated, the RSI is a numerical number. It's momentum indicator. If you get to numbers above 70, 75, 80, it means you're getting overbought. You want to be very careful. You want to sell or reduce your position size maybe, depending on your trading system. This is just one illustration. Any move below 30 usually represents oversold, and you want to, you don't want to consider any new short positions, and new long positions may be warranted depending on other things in your trading system. So let's look at the chart. So this is actually from our trading simulator, and in the top frame you can see the price chart of the mini S&P, the micro E-mini S&P 500 futures, and there's a bunch of arrows there for buying and selling and buying and selling. In the bottom panel you see, and in the middle there, the bottom panel is the RSI, the relative strength index, and shaded in pink is anything between 30 and 70. Anything outside of 70 is overbought generally, in general, and anything below 30 is getting oversold. So back on July 19th, sometime in the morning or afternoon, the market hit 3190 and the RSI got below 30. All right. That initiated a buy signal. The gentleman that I know, the illustration, buys 10 call options. All right. The market rallies. Perfect timing for this guy. The market rallies and he sells 5 contracts as soon as the RSI goes above 70. Well, it went to 75. That went to 80 actually. So you get a nice sell signal. Then you don't have to sell all your contracts because you have more than a one lot. You sell 5 contracts. The market continues to rally. Again, the RSI goes to the 80 level. You sell 3 more. So now you've offset 80 of your contracts, leaving 2 to run. And then again, the market continues to rally and the RSI goes to almost 85 or 90. Definitely sell out the remaining. So that was a good trade, and you can see the market reversed shortly thereafter. When you get RSI readings that high, you eventually will reverse. Just takes time. Now, sometimes I've seen the market go RSIs all the way up to 95, 99. Gold in 1979-80, the RSI made it to 98, I believe. And the same thing with silver when it went up to $50 an ounce. So just because you see an RSI of 80 or 85, it usually indicates topping action, but you can go higher. I've seen treasury bonds get to 6 on a monthly basis. I've seen all sorts of wacky numbers, so be careful. It's only one trading signal, and it's not 100% reliable, as you all know. All right, and this is obviously this is an illustration for educational purposes. So there you go. That's how you can scale in. You can buy 10 and just generally let some go every step of the way up. If you did a one lot, you couldn't do that. So precision scaling is much easier with the micro contracts. This is precision scaling, just to show another concept here. You can see the futures, 3194.50, and then on July 21st, they settled at 32.51. So they moved about 57 points. Look at the options, though. The 3200 call went up. You made money. It did well, but it only went up about 22 points from 56 to 78. The reason why is because, one, you have time to expiration. You had time decay for a couple of days. You also had changes in volatility. You also had a delta factor to worry about. These are not deep in the money options. They're not going to move the same as the futures. They're not going to move point for point, tick for tick. An option with a delta of 49 is only going to move 49% as much as the underlying. So if the underlying moves 50 points, yours is only going to move about 25 points, the option. So you have to be very careful and learn to think in 4 dimensions. It's not difficult to do. You can train your mind. You just have to have some trading experience. There are some people that, they turn off. They say, I can't think in 4 dimensions. Yes, you can. You can train your mind to do it. You just have to trade some options, do them on the simulator if you want, and learn how options behave relative to how the underlying futures behave, okay? All right, we're going to skip a couple charts here and go to NASDAQ. Let's go back to the S&P. Most of you have seen volatility charts. This is the volatility, implied volatility going back 3 years, ending last Friday, August 21st, all right? And you can see on the low side, volatility got down to around 6-7%. On the high side, around 30-35%, except when you have a global pandemic and you shut down an economy and you carve 37% off the S&P 500. Then you get volatility at 76%. And that's incredible, very, very high. If you were buying options at that 76% level, wow, it'd be very difficult to make money. You could, but those are very astronomical premiums. Astronomical premiums. So you can see generally what's high, what's low, what's average, but is there a way to get a little more granularity? Is there a way to drill down and get more detail to see how volatility impacts your options strategy or your options premium? Like I said many times, options are 4-dimensional instruments. The impact of volatility is incredibly high. You cannot ignore it, okay? Unless you happen to be in a very average volatility environment and believe that you're going to stay that way for a long time. So how do we get granularity? Well, for those of you that have watched any of our webinars or seminars over the last 20 years, we do volatility percentile rankings. Very simple to do. The concept very akin to when you took your college entrance exam. For those of you that took your SAT test, you got 2 scores. You got a raw score and a percentile ranking. If you got 790, that's your raw score. The percentile ranking would be 99 percentile, meaning you beat 99% of the people who took the test, and you were able, if you wanted to go to a prestigious college or university. If you scored in the 20th percentile, 80% of the people that beat you, and you only beat 20% of the folks that took the test, and you probably would take the test over again, or you wouldn't go to a prestigious school. You probably go on and become a very successful entrepreneur, because there is no guarantee of intelligence. There's no correlation between intelligence and trading success. That I know for sure. I know some very, very smart people that can't trade worth a darn, and I know some people that don't have high school diplomas and they make $600,000 a year trading. So it's more of a temperament deal or a personality deal than it is, raw intelligence and IQ. So the highest it's been traded in the last 3 years, implied volatility, the highest it was in the last 3 years was 75.77. The 90th percentile represented by 24%. 16% volatility was the 74th percentile. The whole point of this is you want to avoid buying options in the higher percentiles. You want to avoid selling options in the lower percentiles. But the most important thing on this chart is look at the impact on the at-the-money straddle. Look at the high. The at-the-money straddle in points is $556. That corresponds to an E-mini S&P option, $27,000. With the micro E-mini, it would be $2,700 because it's 1/10 the size. Just go down to the 90th percentile, just 1/10 percentile rankings lower. Look at the straddle. It goes from 556 to 182. You sure you want to buy options in high volatility environments? That's what can happen. Just volatility going down to the 90th percentile is going to take about $18,000 off the price of that straddle in dollars, and about $1,800 in the price of the micro E-mini straddle. And you can see all the way down to the 10th percentile, and the low 6.5% is the lowest volatility it's been in that 3-year period. The straddle cost less than 1/10 the value that it did at the high volatility. So if you don't think options volatility has an impact on premiums, look at these percentile rankings. You got to align your strategy with the right, volatility environment. And if you're looking to buy straddles, do not do it in the 99th percentile or even the 90th percentile, because the chances of you making money are less. All right, we'll skip a few slides here real quickly because we're running out of time. I think it's 11:16. Yeah, I got about 4 more minutes, then we got to take questions. So I want to talk about quick strike a little bit. And all traders, before you make, like I said, futures are 2-dimensional. You worry about up and down, that's it. Options, you worry about up, down, time to expiration, and impact of volatility. So before you make a trade, and I try to teach this to in beginning of seminars, which I haven't done in a while, but all traders should be able to do their upside break even, calculate their downside risk, calculate how sensitive the option is to movement in the underlying futures, how volatility impacts their option, and the passage of time, how it impacts their premium, and other things. Quick Strike is a tool. It's free. It's on our website. It'll allow you to calculate these things. So let's say a trader believes the market will advance to new highs before the September 21st expiration. I was guessing here, okay? The market's gone dramatically higher, but I was just making a guess. With the Fed being very accommodative, I figured the market would rally a little bit more, but that's not an opinion of the Merc. That's me. Given the large market swings, they want to do options to limit their risk. So a trader goes long a micro E-mini 3260 call option in September. He pays $111. So the premium is $555 because it's 111 times 5. Sorry about that. All right, so as most smart traders would do, they calculate the following: maximum risk, maximum reward, so on and so forth. Well, let's look at Quick Strike. You can see the panel on the mostly taking up the left 2/3 or more than half of the page. You can see the strikes down the middle, 3150, 3160, 3170, all the way down to 3260. You can see calls on one side, puts on the other. You can see the premium, $111 and $12. It's highlighted in the red rectangle. And there's one. There's not a negative in front of it, so that means you're long one call. If there was negative, it would mean you were short one call. And you can insert any position you want. If you're a complex trader and you have multiple strike prices out on the market, or you're a market maker, you can put in all your positions, and it will help analyze this, and it will give you these 4 dimensions in 4 simple numbers. So the premium, there it is, 111.12. Your long one call. Here's Quick Strike. Again, look in the rectangular box. It calculates your Greeks. Remember I said 4 dimensions? delta, gamma, theta, and vega, or delta, gamma, vega, and theta. You can see the delta is 52%. Your 3260 call will move about 52% as much as the underlying. Underlying moves 10 points, you'll move 5.2 points. All right. Gamma tells you how much your delta is going to change. Remember, short-term options have big gammas. Gamma, you just add, it's additive. So if we move up 10 points, the delta can go from 52 plus 14.4. Little decimal convention you have to get past there, but your new delta will be 66.4. And if we keep going up, the deltas will get higher and higher, and then that option will behave like a deep in the money option, and it will eventually get to a delta of 99.9, assuming the market continues to rally and it goes deep in the money. Vega tells you how many points they're going to gain or lose on a 1 percentage point change in implied volatility. So volatility goes from 21 to 20%, you're going to lose 5.22 points. All right, you can convert to dollars too very easily. Theta is the time decay. If you're long options, your time decay is negative. All right, your time decay is negative. So you'll lose 0.93 points every day that goes by due to time decay. All right, so I'm going to kind of hurry up along, but you'll have to play with this a little bit. For those of you that are familiar with options, this will be really easy. For those of you that are not familiar, this is the way to learn options. It'll be confusing at first, maybe, but there's all sorts of tutorials, and you can get Quick Strike off of our website. It's a very good analytical tool, especially for newcomers that want to learn how options behave, because you can do all sorts of simulations. All right. And there's your typical hockey stick diagram for a long call. As you go higher and higher, the call gets worth more and more money. As you go down, the most you can lose is 111 points. That's it. So how do we calculate all those things that I implored traders to calculate before you do the trade? Well, what's the maximum risk? Premium paid. Maximum reward? Theoretically unlimited. Upside break even? Strike plus the premium. How sensitive is the options relative to the underlying? The delta tells you that, 52%. If volatility drops from 21 to 20, how will this impact the premium? It'll drop by 5.22 points. If it goes from 20 to 19, it'll drop another 5.22 points. And if you want to convert that to dollars, you just multiply by $5 per point. Theta, it's 0.93 points times $5 a point, and that's $4.65 a day will be lost from time decay. So you got to watch these things. All right, I'm going to skip a few slides, and we're going to go to key takeaways. So the micro E-mini options contract can benefit newer traders and those with smaller account sizes. All right, the micro E-mini options, they have a lot of advantage when you compare them with ETFs or ETF options. The micro E-mini options allow newer traders to reduce risk from two standpoints: one, margin; two, dollars at risk, because the premiums are smaller, because the notional values are smaller. The micro E-mini option contracts offer all the advantages of our larger products, the E-mini and the standard products, but 1/10 the size. Micros can be used by traders, hedgers, spreaders, smaller institutions, anyone that wants to trade options, micros can be used by. And micro E-mini options traders, they will enjoy around-the-clock trading accessibility. All right. All right, for those new to futures and options on futures, they have to be traded from a futures account. It's not complicated to open a futures account. It's very simple. Many firms will allow you to do it online or whatever. They may require separate futures account documentation, financial disclosures, and things like that. Well worth it. You got to have a futures contract. As we gave you all the reasons why you'd want to trade these things, you need a futures contract. There may be other minimum account thresholds, but they vary from broker to broker. Talk to Ironbeam. They can go over all those requirements with you. Margin with futures is different than margin with stocks or ETFs. You have to know that. Any strategy that can be done with E-minis can be done with micro E-minis. And given the four-dimensional nature of options, it is imperative that you do your homework. All right. So some tools, quick strike tools. You can just go to cmegroup.com/equity options. We have a daily options report. You can get, volume, open interest. You can get spread activity. There's a lot of information we have on our website, and it's free. When I first started trading options, I paid thousands of dollars for option software. Quick Strike lets you do most of what you can do with professional software for free. Just some resources there. I again encourage everyone to go to cmegroup.com/activetraders/micro-e-mini-options/. You could just click on the link there. We have a trading simulator. We have an active trader website. We have our educational site on cmegroup.com. We have tons hundreds and hundreds of webinars, seminars, educational modules, Trader's Edge segments and installments, and a lot of things that will help you with you advance your learning curve. Also, I would advise people, there's 2 books on options. There's hundreds of books on options. I believe these are 2 of the best ones. I've read them, both of them twice. Options as a Strategic Investment by Larry McMillan, and Options Volatility by Sheldon Natenberg. I know both authors. One I used to trade on the floor in the Treasury bond options pit with. Larry McMillan's a fixture in options. He sold over 500,000 books. That's incredible because you've seen it, it's 3 inches thick. So it's chock full of information, and you need to digest a lot of it before you start trading. You got to start somewhere, and that's a great place to do it. And finally, before we take questions now, we'll have a few minutes for a Q&A. Start small. We're launching this product because it will fill a need. Start small. Jeff Bezos, who's pictured in the diagram at one of his early deaths, started small. He started selling books. And 10 years later, he's completely upended the retail industry globally. So success is the sum of small efforts, repeated day in and day out, according to Robert Collier. Nothing wrong with starting small. Jeff Bezos did, and he started small, and he is now the richest person on the planet by far. So start small, and feel free to ask questions, and we'll take questions now.
So Dave, I'll read you the first couple here, and just as Dave said, if you have any questions, feel free to put it in the question box. There should be one on your screen. The first one is, are there plans to launch micro Russell options?
Not as of now, but you can bet. Who's the wise guy? You can bet that when we develop liquidity in micro E-mini S&P and the micro E-mini Nasdaq, the calls for Russell and the Dow will get greater and greater. And I think especially with the Dow, because of the recent changes, I can't believe it, they kicked ExxonMobil, Pfizer, and one other company out, and they put in Salesforce.com, Amgen, and Honeywell. They made those things, they're higher priced stocks. They'll adjust the divisor, of course, but Salesforce.com is a $250 stock. That is going to be very interesting when that thing moves, because the Dow is a price weighted index. So you may see the calls for Dow sooner than you think, but yeah, down the road, I would imagine we would strongly consider it.
Okay. The next question, it isn't too clear here. It says, do you know whether it's an American or European for an assignment? I know our platform would tell you, if you just look at symbol information, it's going to tell you if it's American or European.
Yeah, generally the quarterlies are the only ones that are American style. Everything else is European style. So if you trade a weekly option, you can't exercise until the end. Same thing with end of month, the serials, and the weeklies. The quarterlies are all American. So everything else is European.
Okay. The next one, someone is asking if it's possible for them to become a market maker. Is there some section on the CME site for that?
John, are you on the line?
Yes, I'm here.
Okay, John, can you connect Mike with probably Richard Coe would be the one that's taking market maker applications, I believe.
Absolutely. Mike, I'll send you that information after this, and then we can relay it to whoever's interested.
Sweet.
Yeah, copy Tim McCord on it too, okay?
Okay.
Will do.
Thank you. Next question.
Next question, this is a good one. How much history does QuickStripe have on ES options, or I guess in general, really, but basically how far does the data go back, and then also can it be downloaded into Excel?
Yes, and yes. Those charts that I made were done in Excel. The rank and percentile was done in Excel. You can download. It's very easy. I even figured it out in a couple seconds, and I am technologically challenged when it comes to Excel spreadsheets. But yes, you can download all that. You can go way back in history. You can get at least 12 years in the metals, because I just recently ran some volatility percentile rankings on gold and silver, and it went back 12 years. I think it goes back to inception with certain products. So the E-mini S&P 500, try it. I'm not sure if you can go all the way back to 1997, but you may have to get, your data from something else if you want to go back that far. But easily you can get 3 years, 5 years of volatility data, 10 years in many products. But don't quote me on it, but at least 3 years, as long as it's been trading at least 3 years. Okay.
Cool. Next one is there any pattern day trading rule? I can tackle this. There's no pattern day trading rule for futures or options on futures. So you don't have to have like a special privilege like you do with stocks to trade more than 3 times. So that's not an issue with futures.
Yeah, that's an excellent advantage that somehow didn't make it into this presentation. But yeah, no pattern day trader rule. I should put that in my comparison chart.
Someone here was asking what the 4th dimension was. They listed delta, theta, and gamma, and they asked what the last one was.
It's actually the up and down movement, the futures price in relation to the strike price. So you have to worry about up and down movement, which is just the futures in relation to the strike price. So that would be delta, and then gamma, and then theta, time decay, and vega would be volatility. So up, down, time to expiration, and volatility, basically. Actually, some people think up and down that's one dimension. So maybe options are really 3-dimensional, if you want to get technical about it. But those 4 numbers, delta, gamma, theta, and vega, if you put a complex position in and you have good software like QuickStrike, it'll calculate those 4 numbers for a very complicated position. And it'll be like your dashboard. With 4 numbers, any market maker on the trading floor or any market maker in an electronic trading system can tell where he's at. If the market moves up, is he going to lose money? If the market has a large move, is he going to lose a lot of money or make a lot of money? Every day that goes by, how many thousands of dollars is he going to lose in time decay? If volatility goes from 21% down to 17%, how is his position going to look? Those 4 numbers, those 4 dimensions, delta, gamma, theta, and vega, will tell any options trader where he's at.
So the next question, and I believe they're all the same, but is there any exchange fee differential between the different micro options?
You could go to the CME website. I have no intention of ever memorizing our fee schedule. It's a couple pages long, but I don't know how the fees are going to be structured yet. But on our website, it would show those long before we launch them. But it will be embedded in the commission of the firm that at Ironbeam. So.
Okay. Another person is asking, is there any current interest in offering micro options on either currencies or metals?
Well, we have micro futures on the metals and the currencies, but once those establish some core liquidity, and they've done very well. The micro metals skyrocket in interest. The thing is, we want to be very careful not to dilute our pool of liquidity. So we launch these things. Sometimes we wait for core liquidity to develop. So again, if we get enough demand, we launch them, right?
This looks like the last question. If anyone has anything else, feel free to put it in. And I'm not sure Dave will be able to answer this, but they're basically asking, since volatility is down since March, when will futures margins start to relax a little bit?
Oh, great question. Yeah, futures margins are usually the result of contract notional size and volatility. Now, we've had a raging bull market, so the notional value of some of the contracts just continues to go higher. So that puts upward pressure on margins. But we're still, believe it or not, we're in a very high volatility environment. Even though volatility has come down dramatically, it's still high. As a matter of fact, let me just get to my slide here on volatility percentile. Yeah, for the E-mini S&P 500, the high it got up to 75%. I think currently we're like in the high teens, low 20s, so we're still in the 80th percentile. They're still expensive, which means that there's going to be a certain amount of movement. We're going to move at least 1.5% every day. So as a result, they want to take into account every possibility, and they want a 99% or a 90% coverage. They want to be able to cover 90% of the various moves that we can have in future. And when volatility is at 20%, you're going to move more than a percent every day. Well, on a $200,000 contract, that is what? $2,000. So, your margins have to be accordingly. You have to be able to take into account a 2 or 3 or 4% move occasionally. But they will come down as volatility continues to go down and the market, gets normal and this COVID-19 kind of passes by, and we hope that it does. I think volatility gets crushed at some point or heads down, and margins will go down too. But certainly not in gold and silver because the volatility is way up. It's near 60% in silver. There's no way margins are coming down with volatility at 60%. All right.
Perfect. That might be it. There was a couple questions about getting copies of the PowerPoint or this webinar as a whole, just so anyone knows. Everyone that attended, you'll get an email with a link to the video recording of this, as well as I'll probably convert the slides into a PDF or something like that and email that out as well.
Yeah, you have permission to do that.
And I think that takes care of everything. I'll give everyone like 30 more seconds just in case you want to slide one last question in there, but that might do it. I think that's it. Dave, you got anything else?
Nope.
Sounds good to me. Thanks for everyone for joining. Thanks, Dave, for doing the presentation. We appreciate it.
You're welcome. Anytime.
Awesome. All right. Thanks, everyone, for coming. I'm going to go ahead and end this. If you have any questions or anything, feel free to shoot me an email at mike.murphy@Ironbeam, or you can just send an email to our general email at trading@ironbeam.com.